Welcome back. Good afternoon. Thank you guys for watching this video today. The question is, why can't we afford housing? Why can't Americans afford housing? That's going to be today's question. And this video is going to be a continuation of the first two videos that we released. And in those first two videos, we were discussing Federal Reserve policy and the impact that it's having on the economy, including the housing market. And so the Fed policy also has had an impact on home prices. It always has an impact on home prices. And so we're going to take a look at what's happening and the reason why Americans are struggling to afford homes. Again, like I said, before we really get into it, please make sure you like this video, subscribe to the channel, and also make sure you hit the notification bell. And I really do hope you enjoy the video, so let's get right into it. If you're wondering why we can't afford housing these days, you'll have to begin with the hedge funds and the large institutions purchasing homes. They've been doing it at record pace over the last decade. I remember seeing an article a couple of days ago by Barry Zagaz and Gene Slater. Um, they basically cited that institutional investors have purchased 13% of all homes that were for sale in 2021. Honestly, this doesn't even include the small time investors that have been also buying up homes. And so real estate investors essentially have been leaving fewer and fewer homes in the marketplace for the rest of the Americans to basically compete over. And folks, it's pretty much as simple as that. There's just basically way more investors operating in this not just single family, but also in the multi-family home market. And like I said, it's just leaving less and less homes for the rest of us to compete over. Now, it's important to ask, how is this possible? What is making it possible for investors, especially large institutional investors, to basically take over the marketplace the way they've been able to do so? And so, honestly, the best thing to do is just to look at the Federal Reserve balance sheet. A lot of the data that we have suggests that the um, Fed's policy is responsible for a lot of basically large institutional investors operating in this space. And so one of the things we did, we looked at basically some of the data, and you can see that the Fed's balance sheet seems to move in lockstep with the value of homes. And so essentially, every time the Fed engaged in quantitative easing, home prices increase with the balance sheet. And in the reverse, when they engage in quantitative tightening, the balance sheet shrinks, and home prices tend to also go down as a result. Um, in 2022, actually, the Fed had been raising rates and also reducing the balance sheet at the same time. And so, as a result, this year we've been seeing we've been seeing home prices stabilize and even fall in some markets, right? And so, as the prices fall, is this safe for families to secure a place? Is it safe for people to go out there to secure a home for their family in order for them to grow for their future? And that's a very interesting question. Although prices have been falling, the rates have been rising really quickly. Right? And so, if you're looking for a place for your family to grow, speculating may not be the best idea. It's just, I think at this moment, maybe um, getting a home your family can afford for a price that's comparable to your neighbors, and of course, making sure you have a reasonable interest rate. It just might be the best option at the moment. And so, um, it's just this is just something you don't want to speculate over right now, especially with the market being as hot as it is, and also given the fact that interest rates are rising very quickly. It's just, you have to just keep in mind, this is something where your family is going to be there over for a very long period of time. And so, although maybe um, you purchased when the prices were slightly inflated, however, over time, hopefully, the values basically adjust higher, and you end up your family ends up in a better place in the future. Well, for investors, if you're an investor, honestly, the high prices along with the higher rates may not be economically feasible. So real estate investors really would just have to explore all the different financing options that they have. And real estate investors, obviously, like I said, because of all the money that's slushing around there in the system, uh, there's no shortage of financing options for a lot of projects that they have. And so one thing I did, I prepared a table that allows us to look at how much a household income needs to be for you to either buy or rent a home in Jersey City. So we started with basically trying to figure out what the average home price in Jersey City is as of August 2022. According to Zillow, the average home price in Jersey City is about $612,000. In order to afford, um, in order to afford this home, a home worth this amount of money in Jersey City, your household income needs to be at least $100,000, and that's even if you qualify, if the bank qualifies you for a loan with this at this income level. Now, if you're able to get over that initial hurdle that requires you to put down $122,000 down, which is the 20%, plus let's say $10 to $14,000 for closing costs, your family is going to have a place that you guys can basically live and grow together, right? And then the other good thing as well is like uh, you basically you will have stability in your housing costs, right? So instead of being a renter with renters, you don't have control over that cost. The landlord can raise that price. They tend to raise their price from year to year. But as a homeowner, you have total control over that, given basic, pretty much pretty good control over it. It's all based on basically the financing that you receive from the bank, right? And so when you're finally in at home with your family, the issue is if you're at this income level, your family, you're going to be cash strapped, right? And if both spouses are working, the average wage would have to be about $26 an hour. So, and the monthly projected income after taxes will have to be around $6,500, right? Your projected expense at this, your projected expenses is probably going to be around $5,900 to $6,000. So it's going to leave you. It's not going to leave you a lot of room for error. So it leaves you about basically $500 remaining. If things go perfectly, you'll have $500 remaining at the end of the month for savings and hopefully to also pad your retirement account. But it's just preferably if you're buying a home, you definitely want to be in a situation where you can afford it, and also you want to be able to have enough money in your account in reserves for like any emergency in case, let's say, um, you lose your job or you get injured and you can't work anymore. It's very important to make sure you have some money in your account for reserve. So obviously, so your family is able to maintain the home that you have. Preferably, you want your income to be higher than the $100,000. A good test is to basically look at the ratio of your mortgage to your monthly your monthly income. I will do it basically after taxes. And so with this here, this is at 40%, about 41%. And the good rule of thumb is you want your household expenses to be, you want your housing expense, your rent or mortgage expense, you want it to be around 33%. And so if it's around 33%, um, life will be a lot easier and your family will be able to live a lot more comfortably. If you're a renter, it's a little different. If you're a renter, you obviously don't need as much money. However, uh, if you're renting, it will cost you about $2,000 to rent a home or apartment for a family of three or four here in Jersey City, right? Uh, your household income will have to be about $73,000. And the interesting thing is, this is actually in 2022. I think this might be the average household income in the United States. This is basically around 72,900 or $73,000. But at this level, uh, it's still pretty tight, right? For a family of three or four, assuming it's like, let's say, a two bedroom, a decent sized two bedroom, one bath, is going to cost at least $2,000. It's not, honestly, Jersey City is not even the only place that charges this amount. I've looked at different markets before, and it seems like for basically two to three bedroom, for a family of three or four, you're going to pay close to about $2,000 for an apartment. So now, like I said, the annual household income will have to be around $73,000. Your projected monthly income after taxes, you will have to, for you to be able to afford to live in Jersey City or even in most major metropolitan areas in the United States, after tax income will have to be around $4,700 a month. You project your expenses to be around 4,300. Again, it doesn't leave you with a lot of room for error. You're only left with about $450 at the end of the month if things go perfectly for you to pad your savings or your retirement account. The other thing I wanted to look at is basically the ratio of your rent expense to your income, to your monthly income, household income. As we see here, this is sitting at 42%. And so it's not really that healthy. It's you want, like I said, you want this ratio to always be around 33%. So the lower this ratio is, the more comfortably your family is going to live, and the better things are going to be for your family. So this is pretty much what I have. Let me know what you guys think, right? I need to hear from you guys. Have your prices, have, rent prices gone up for you guys? Let me know how much has gone up by. Let me know how you feel about it. Um, I promise to make sure I respond to every comment. Again, before you guys go, make sure you like the video, subscribe to the channel, and also hit the notification bell so you guys are notified the next time I drop a video. And so I'll catch you guys on the next one. Thank you so much.